Now that we know about two depreciation methods, can we chop and change? Well, the answer is no. What we should do is once we've chosen a method for a particular asset, it should be used for the asset's entire useful life. So we shouldn't change midway through or revert back to the original. What we want to do is say if I've got shop fittings, coat hangers and racks and so on, let's use straight line depreciation year 1, year 2, year 3, year 4. If I've got a delivery van or a car, I should use reducing balance in year 1, year 2, year 3, year 4. If I've got shop fittings and I use straight line in year 1 and then change it to reducing balance and then go back to reducing balance in year 3 and then finish up with straight line in year 4, that's wrong. That's not the right thing to do. We can't chop and change methods, and we'll talk about why in a second. With a delivery van, if I've chosen reducing balance in year 1, 2 and 3, I can't change to straight line in year 4. So why should the same method be picked each period? Well, the answer's in the theory. We want to apply the consistency principle, use the same accounting methods every period, and that allows us to compare our performance over time. Comparability as a qualitative characteristic says the same thing. Apply your accounting methods consistently, and then we can again compare our performance over time. So using the same method is going to allow us to do that. What we're not saying, or what we're not saying, is that you don't have to pick the same method for all your assets. So you can chop and change within each asset type, but once you've picked a method for a particular asset, you've got to stick with it. So for example, with the shop fittings, we might use straight line, but straight line's not appropriate for machinery or vehicles, so we might use reducing balance instead. But office furniture, that's going to generate roughly the same revenue every year, so we're going to use straight line for that one. That's okay. That's not breaching consistency or comparability. We can still compare the office furniture over time. That's acceptable to chop and change methods within your asset portfolio. So looking at this example here, we're going to have shop fittings, machinery, vehicles and office furniture. We're going to have a depreciation graph each year for 2015, 16, 17, 18. So we can see shop fittings, we charged $1,000 in year 1, then year 2 the same, year 3, year 4. That seems like the right thing to do. Machinery, we said we use reducing balance. So year 1 was there, 2 it decreased, 3 and 4, that makes sense. Vehicles, we've got quite a big amount of depreciation year 1, then it's decreased. We've used reducing balance, which makes sense. And office furniture, revenue generating capacity the same, so we've kept it the same every year. We've applied consistency and comparability perfectly. So that is the correct method. Let's look at some wrong things. Let's look at shop fittings in year 1, 2, 3, 4. Well, that seems okay. We've used straight line every year. Let's look at machinery. We started off with about $1,500 or so. It's decreased. That seems correct for machinery. Should reduce using reducing balance. But then we got a problem. It looks like we've charged the same amount in year 3 here. So if we just go back, that's not okay. We can't. Looks like we've changed methods from year 2 to year 3. And that's not acceptable. Now in year 4 we've gone back to the correct method, but then we've breached comparability again because the year before that we'd apply a straight line. So we've got a total breach of comparability there. Let's look at the vehicles. We've got it starting up quite high, decreasing, decreasing, decreasing. That seems okay. We've applied reducing balance to an asset that's going to generate less revenue. Let's look at the office furniture. It starts up here and then stays the same. Then it's decreased and decreased again. So clearly they've changed depreciation methods after that second year, and that's a breach. So we've got a couple of mistakes with that example there.